Welcome to another session of the My Solo 401k Financial YouTube and LinkedIn webinar series. We're going to get started momentarily. We're just waiting for the viewers to join and just confirming the audio. Okay, the audio sounds good. All right, so we're going to get started with some housekeeping, and then we'll jump into today's session. If you have questions as we go through the slides, please feel free to chat them over through the YouTube chat feature. Again, please like this video and subscribe. So today's session, we're going through a deep dive discussion contributions guide for 2021 and 2022 in terms of solo 401k contributions. And this session is designed for self-employed people whose business is taxed as an S corporation, a C corporation, or an LLC taxed as an S corporation or as a C corporation. This presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. Before we jump in, I want to highlight some of the great resources we have. So we have our community site, mysolo401k.net/mycommunity. It's free to join, all are welcome. We have webinars every single day on the community site. You can see our upcoming schedule. This is the first of many deep dive contribution webinars. So there'll be another one tomorrow in the community focused on Mega Backdoor Roth contributions. And then we'll be back on Friday to continue that conversation. And then next week we'll turn to partnerships, and the week after that, sole proprietorships. Another great venue to post questions is our community forums, where you can see people are posting questions throughout the day and we're responding. So it's free to post, it's free to go and view it and see what others are asking about. It's a great way to learn. So with that, let's turn and take a look at the agenda for today's discussion. So we're going to talk about, again, 2021 and 2022 solo 401k contributions with a focus on businesses that are taxed as an S corporation or as a C corporation. We're going to take a look at the contribution limits, scenarios, and examples, how to use the online calculator, the deadlines, how to make contributions, how to report contributions, what is not a contribution. So if you're not able to stay for the whole session, that's okay. Come back to the YouTube channel, as there will be a link to this recording. You can come back and watch later. Please stay tuned on our website, as we'll also be posting the slides to today's session. So anytime we talk about making contributions, it comes down and it depends on the specific situation. So it depends on, number one, your self-employment income, number two, your age, whether you participate in another retirement plan, like a 401k plan through a day job, and the type of contribution that you're looking to make, whether that's an employee or employer, whether that's pre-tax, Roth, or voluntary after tax. And as we go through the examples and the scenarios, this will become more clear. So the starting point is that you, again, have to consider your self-employment income. So the whole purpose of a 401k is for people who work to save for retirement. So the purpose of a solo 401k was for a self-employed individual to be able to save for retirement. So the starting point is having earned self-employment income. So it's, in other words, not for investors or owners to save for retirement. It's for workers, or in this case, self-employed individuals. So when your business is taxed as an S corporation or C corporation, or an LLC taxed as an S corporation or C corporation, your ability to make solo 401k contributions is based on the W-2 wages that you receive from your self-employed business, and not, for example, the W-2 wages that you might also receive from your daytime job. You also are not going to consider the K-1 that you receive from your business taxed as an S corporation, because that's really the income that you receive as an owner of the business, as opposed to the earned income that you receive on your W-2. So you first need to determine that earned income. So again, it's the W-2 wages. It's not based on passive income. You would use box 1 of the W-2 and then add back in any pre-tax selective deferrals, or in other words, employee contributions that are not on box 1, but are instead in box 12 of the W-2. You then are going to determine the contribution year and amount. So the IRS increased the contribution limits for 2022. For 2021, the overall limit is $58,000, or an additional $6,500 if you're 50 or older, for a total of $64,500. For 2022, that overall limit increased by $3,000. So the annual limit is $61,000, or an additional $6,500 catch up if you are age 50 or older. Next, you're going to determine the contribution type. So you can make different types of contributions to a solo 401k. Because in the words of the IRS, you're both the employee as well as the employer. So you can make employee contributions, which may be made as pre-tax, Roth, or voluntary after tax. You could also make employer contributions, which are always going to be considered pre-tax contributions. Now, the employee limit, as we will see as we go through the slides, applies at the employee level. So if you are making contributions to a 401k plan through your job, that will reduce how much you can contribute to the solo 401k as an employee contribution. But contributions that are made by you or on your behalf to another 401k plan sponsored by an unrelated employer, like a day job plan, will not reduce how much you can make as an employer contribution. It also doesn't impact the after-tax limit. So we'll see that as we go through the slides. And we'll be thank you so much for sending the questions through. We'll be taking a look at the questions after we get a chance to go through the slides. So please, thank you for your patience. So we're first going to take a look at, now we're going to turn and take a deeper dive and look at the limits themselves. So the first limit we're going to look at is the employee contribution limit, focusing on pre-tax contributions. So these are contributions that reduce your taxable income for the year that you're making the contribution for. So that employee contribution, also referred to as a salary deferral, the limit is 100% of the W-2 wages from your self-employed business taxed as an S-corp or a C-corp. So dollar for dollar, 100%, not to exceed $19,500 for 2021, or an additional $6,500 if you're 50 or older. So that limit, as we saw, that limit is going to go up for 2022. So for 2022, it's 100% of the W-2 wages from your self-employed business, dollar for dollar, not to exceed $20,500 or $27,000 if you're 50 or older. So this is the limit, though, that will be reduced by any contributions that you make to another plan, like the day job plan. Now, unless that other plan is a 457 governmental plan. In that case, the contributions that you make to the 457 won't reduce the amount of employee contributions that you can make to the solo. Now you have the option to make the employee contribution as a Roth contribution. It could be pre-tax, it could be either or, right? You could do all pre-tax or all Roth, or you could do a mixture up to that limit of $19,500 for 2021 or $20,500 for 2022. And if you're 50 or older, an additional $6,500 as a catch-up. Now, if you elect to make a Roth contribution to the solo 401k, it needs to be made into a separate sub-account. So as part of our onboarding process, we will find out from you how many accounts you need, right? What type of contributions that you wish to make, so that we can prepare the paperwork to open up the different sub-accounts. So you might have a pre-tax account and a Roth account. If your spouse or business partner is also participating in the solo 401k, then there'll be separate accounts for that person. So in that case, it could be 4, right? Pre-tax and Roth for, say, both husband and wife. And as we see, it may even go up to 6 if you're also making after-tax contributions. So next, let's take a look at the limit that applies to employer contributions. Now, employer contributions are also referred to as profit-sharing contributions. That's a synonym. Employer contributions are always pre-tax contributions. So they're not made as a Roth, for example. The limit is 25% of your W-2 wages. So here, this is where you would take box 1 of the W-2 plus any pre-tax elected deferrals not in box 1. So let's take a simple example. Let's say you have $100,000 of W-2 wages from your self-employed business taxed as an S-corp, and you elect to make a $19,500 pre-tax employee contribution for 2021. So that means that box 1 of your W-2 would be $80,500. In box 12 of the W-2 would have $19,500. So in determining how much you can contribute as an employer contribution, you would take $80,500 plus the $19,500 not in box 1 but over in box 12 for a total of $100,000 times 25%. So you could, in that case, make a $25,000 employer profit sharing contribution. Now, keep in mind that the total amount of contributions that are made to the plan can't exceed the overall limit, which is $58,000 or $64,500 if you're 50 or older for 2021. For 2022, it's $61,000 or $67,500 if you're 50 or older. Finally, it's not impacted by contributions made to another plan through an unrelated employer, the so-called day job 401k plan, unless those contributions are made to a 403b, in which case you have to also consider contributions made to a 403b, and that'll reduce how much can be contributed. You have to aggregate, in other words. Now we'll take a look at the voluntary after-tax contribution limit. And this is how people make so-called Mega Backdoor Roth Solo 401k contributions. So the voluntary after-tax contribution limit is equal to the lesser of your self-employment compensation, which, remember, is the W-2 wages that you receive from the business taxed as an S-corp or a C-corp, and the overall limit, which, as we know, is $58,000 for 2021 or $61,000 for 2022, reduced by any employee or employer contributions made to the solo 401k. So not reduced by contributions made to the day job plan, but only those made to the solo 401k. Finally, you will ignore any catch-up contributions. So the limit doesn't go up, but you also don't have to reduce it by catch-up contributions made to the solo 401k. And again, it's not impacted by contributions made to another plan unless the other plan is a 403B. Finally, as we alluded to before, voluntary after-tax contributions must be deposited into a separate sub-account for each participant, which is how you might end up with 6 accounts, for example. If there's husband and wife who are both participating in the solo 401k, each might have a pre-tax, Roth, and voluntary after-tax account for a total of 6. Now we're going to turn to contribution scenarios to really see how this plays out with an example, as it can be very instructive. So what we'll do is we'll start with the baseline scenario, and then we'll tweak the different elements to see how that impacts how much can be contributed to the solo. So in our base scenario, we have a self-employed business taxed as an S corporation with one participant who is under 50 years of age. The goal is to maximize pre-tax contributions and then, if possible, make Roth and after-tax contributions. And this individual has $100,000 of W-2 wages. So if the goal is to maximize pre-tax first and then turn to the Roth, the person would make a pre-tax contribution of $19,500 for 2021 or $20,500 for 2022, because they can do 100% of their W-2 wages up to $19,500 for 2021 or $25,000 for 2022. That would go into a pre-tax sub-account. Next, the person would make a $25,000 contribution as an employer. That's 25% of the W-2 wages. Finally, they would still be able to make additional contributions as an after-tax contribution. Because remember, the after-tax limit is the lesser of their self-employment compensation or the overall limit. So here, their self-employment compensation is greater than the overall limit, so you would use the overall limit, reduced by any employee or employer contributions made to the solo. So for 2021, they can make $13,500 in after-tax contributions, which can then be converted over to the Roth Solo 401k, or $15,500 for 2022 as a voluntary after-tax contribution that's converted over to the Solo 401k, to the Roth Solo 401k. So at the end of the day, this person would have $44,500 in their pre-tax sub-account for 2021 and $13,500 in their Roth Solo 401k sub-account for 2021. And then for 2022, they would have $45,500 in their pre-tax Solo 401k sub-account and $15,500 in their Roth Solo 401k sub-account. So now let's change the baseline scenario to see how that impacts how much you can contribute to the plan. So same person, but now they only have $50,000 of W-2 wages. They would still be able to make the same amount of contributions as an employee, $19,500 or $20,500 for 2022. The pre-tax contribution amount would go down because it's 25% of the W-2 wages. So that leaves $12,500. And then their compensation is actually less than the overall limit. So that's the most that can be contributed, right? You cannot save more than you earn. So that would leave $18,000 for 2021 as an after-tax contribution, or $17,000 for 2022 as an after-tax contribution. Okay, so let's go back to the base, but change a different factor. So here, let's assume same person that's making $100,000 of W-2 wages, but they've maximized the employee contributions to their day job plan. So that means they're not going to be able to make any employee contributions to the solo 401k, because remember that employee contribution limit applies at the employee level. So if you've already maximized and made those if you already hit the limit under your day job plan, you won't be able to make any more employee contributions to the solo 401k. But they could still make the employer contribution of 25% or $25,000. And then they could still make the after-tax contribution, because that after-tax limit is not reduced by any contributions made to another plan, unless that was a 403B plan. But here we're assuming that the other plan is not a 403B. So that means for 2021, this person could make $33,000 in voluntary after-tax contributions, or for 2022, $36,000 in voluntary after-tax contributions, because it's the lesser of their self-employment compensation or the overall limit. So their self-employment compensation here is $100,000. So we use the overall limit reduced by the employer contribution of $25,000. Okay, so let's go back to the base. So this person doesn't make any contributions to another plan, still makes $100,000, but now the goal is to maximize the Roth and or voluntary after-tax contributions. So this person is not looking for any income tax reduction benefit now. So this person would still make the $19,500 or $20,500 employee contribution, but now they would put it into their Roth Solo 401k account. They could decline to make the employer contribution because they don't want to make a pre-tax contribution, and employer contributions are always pre-tax. And then they could do the difference up to the overall limit. So that would be another $38,500 for 2021 or $40,500 for 2022 as a voluntary after-tax contribution. So at the end of the day, this person would have $58,000 in their Roth Solo 401k account for 2021, or $61,000 in their Roth Solo 401k sub account for 2022. Okay, so let's go back to the base again. Here, the difference is we have 2 participants instead of 1. So does that change anything? So no, it doesn't change anything in terms of the amounts, but the point that we're trying to highlight is that each person is able to contribute based on their own situation. So based on their age, the W-2 wages that that person receives from the self-employed business, whether that person makes contributions to another plan, etc. Okay, so let's go back to the base, but this time let's assume that the person is 50 or more years of age. What changes? Well, the only thing that changes is that they're now able to make that catch-up contribution. So they would make the $19,500 for 2021 or $20,500 for 2022 as a pre-tax employee contribution, put another $25,000 in as a pre-tax employer, and then do the difference, which is going to be the same amount, because remember, the after-tax contribution limit doesn't go up because you're 50 or older, but you also don't have to reduce those, you don't have to consider those catch-up contributions that were made. So ultimately, you're still able to make another $13,500 as a voluntary after-tax contribution for 2021, or $15,500 as an after-tax contribution for 2022. Okay, so now let's go back to the base. So this person is back to being under 50. They maximize the contributions to the day job, but here they want to only focus on Roth and or after-tax contributions. So this person is not able to make any employee contributions because they already met their limit by the contributions made to the day job plan. They decline to make the employer contributions because those are always pre-tax contributions, and this person doesn't want to make any pre-tax contributions. So ultimately, they make the entire amount up to the overall limit, since they have the self-employment compensation to justify it, as a voluntary after-tax contribution, and then convert those funds over to their Roth Solo 401k sub account. So that'd be $58,000 for 2021 or $61,000 for 2022. Okay, let's take a similar scenario, but we're going to change it up a bit in this same type of person, but now they're 50 or older. So what changes? So nothing. So they still can't make the employee because they hit the limit under their day job. They still don't want to make the employer because they're not interested in pre-tax contributions. So they would just simply make the same 58,000 for 2021 as a voluntary after-tax contribution, or 61,000 for 2022 as a voluntary after-tax contribution. Okay, so we're going back to the person being under 50. Their goal is still to maximize the Roth, but now there's two participants. So what changes? So again, nothing changes in terms of the amounts that can be contributed. The point that we want to convey with this scenario is that each person's ability to contribute is based on their own earned self-employment income, their age, etc. And since each person in this scenario has the exact same age and income, etc., they're each able to make the same amount of contribution. Note, of course, that they would be putting the money into their own separate sub-accounts, like we talked about earlier. So that takes us to the end of the scenarios. So let's keep going with the slides before we turn to the questions. So we do have a great resource on our website, which is our online calculator. So here we're going to talk about how to use that. You can find it at mysolo401k.net. There's a drop-down menu under the word Learn, and the option you would choose is Online Tools. So once you click through to go to the calculator, you will choose a single owner corporation. You will enter the W-2 wages as the net income and enter your age. Now, one thing to note is that you'll need to modify this if you're making contributions to a day job plan. The calculator doesn't contemplate that. You'll also modify it if you're trying to make after-tax contributions. But it's still a helpful tool, and you can print it for your records. Once you've determined how much you're going to contribute, etc., it's time to make the contributions. So we'll talk about that in more detail, but at a high level, this is a great slide as it shows that you can make those contributions by check or wire or other type of electronic deposit. You will deposit the contributions into the Solo 401k account as applicable, right? Pre-tax versus Roth versus voluntary after-tax in different accounts for each participant, and you report those contributions. So let's dig a little bit deeper. So if you want to make the contribution by check, you'll make it payable in the name of the Solo 401k and write annual contribution on the memo section of the check. As I noted, electronic transfer is acceptable. Of course, check with a financial institution that holds the accounts. Many of our clients have their accounts at a brokerage like Fidelity, Schwab, TD Ameritrade, etc. Other than Fidelity, the brokerage firms generally don't allow an electronic deposit from an external account where the name on the external account doesn't match the name on the account at the brokerage, i.e. the name on the external account is not in the name of the Solo 401k. Fidelity is the exception there, though, as they will allow an electronic deposit from an external account where the name of the external account is not in the name of the plan. Each participant deposits his or her contributions into separate sub-accounts. And again, there will be separate sub-accounts for different types of money, pre-tax, Roth, and voluntary after-tax. You may deposit the funds in one lump sum or a series of contributions. You may transfer those funds from a personal or business account. Either is acceptable from a Solo 401k perspective. So when is the deadline to make contributions? What's clear, based on IRS publication 560, which is the landmark guidance from the IRS that deals with retirement plans for self-employed individuals like Solo 401ks, it's clear based on a chart on page 3 of that publication that as long as the plan was set up before the end of the year, so for example, as long as you sign the documents, etc., by the end of the year, you'll preserve the right to make contributions all the way up until your business tax return deadline, including any timely filed extension. So for 2021, that would be March 15th or September 15th of 2022. For 2022 contributions, that'll be March 15th or September 15th of 2023. If your business is taxed as an S-corp. So it's based off of your business tax return deadline. And this is for all types of contributions, employee and employer, even though of course your personal tax return deadline, your 1040 deadline, it might be April 15th or October 15th if you file a timely extension. What drives the deadline for making those employee contributions is the business tax return deadline. So that'll be the S-corp deadline, your 1120S. So how do I report contributions? Well, it depends on the type of contribution that you're referring to. So if you're talking about a pre-tax contribution, which is an employee pre-tax as opposed to employer, those are reported, they're not included in box 1, but instead are reported in box 12 of the W-2 using code D and checking retirement plan field in box 13. Now, alternatively, it is acceptable from a solo 401k perspective for that employee pre-tax contribution to be reported on line 16 of Schedule 1 of your 1040. But you do one or the other. The Roth employee contribution is not going to be taken out of box 1 of the W-2. It's not going to reduce the amount in box 1 because it's not a pre-tax contribution. So you're not reducing your taxable income. But it's still reportable on the W-2. Also in box 12 of the W-2, this time with code AA per those W-2 instructions. Lastly, voluntary after-tax contributions. They're a type of employee contribution. So they may be reported on box 14 of the W-2, but per those W-2 instructions, reporting voluntary after-tax contributions is optional. Like the Roth, it's not going to reduce your income. So there's no income tax reduction benefit now. It's an after-tax contribution. So it's not going to reduce the amount that is in box 1 of the W-2. As far as employer contributions, those are pre-tax contributions, and they would be reported on line 17 of the Form 1120S if you file as an S corporation, or line 23 of the Form 1120 if your business files as a C corporation. So before we turn to the questions, we just have a few more slides. A common question that comes up is, what about matching contributions? Can I also make matching contributions to the solo 401k? So no, matching contributions don't apply to a solo 401k. They only apply to a full-time employer plan. So solo 401k contributions are really limited to the types of contributions that we've been discussing, which are employee, which can be either pre-tax Roth or voluntary after-tax, or employer profit-sharing contributions. So it's noteworthy that the matching contributions are made by the employer when the employee has contributed, right? You might have a 401k plan at your day job, and if you make a contribution, your employer will match that contribution. Profit-sharing contributions that are made to the solo 401k are not dependent on whether you make an employee contribution, right? You could still make the employer profit-sharing contribution even if you don't make employee contributions to the solo 401k, right? You might not be able to because you've already hit your limit under your day job plan, but you can still make employer profit-sharing contributions to the solo. What is not a contribution? So the following amounts are not contributions and therefore are not subject to the contribution limits. So amounts rolled over from a pre-existing retirement account, like a former employer plan or a non-Roth IRA. Earnings from your investment, right? These are all funds that will flow into the solo 401k, but they're not contributions, so they're not subject to the contribution limits. So if you have returns on your investments, right, that'll flow back to the solo 401k account. Money that's converted, right? It could be money that goes from the pre-tax solo 401k sub-account to the Roth sub-account because you're processing an in-plan Roth conversion. That is not considered a contribution and therefore not subject to the contribution limits. Repayments of solo 401k loans, right? One of the top uses of our solo 401k plan by our clients is to take a 401k loan where you borrow money from the plan and then you have to pay it back. So when you deposit the loan payments back into your solo 401k, that is not a contribution that has to be considered for purposes of the contribution limits. So now that takes us to the end of the slides. Thank you so much for the participation. Again, we'd like to highlight that our community website is a great resource. We have forums where you can post questions 24/7. You can see what others are asking. We have webinars, daily webinars, which you have access to. For example, tomorrow we'll be focusing on Mega Backdoor Roth Solo 401k contributions for 2021 and 2022, specifically designed for businesses taxed as S-corps or C-corps. So please continue the conversation there on the community. So now let's turn to the questions. Thank you so much for bringing the questions and the participation. What is the best way to obtain earned income? Through payroll at the end of the year, or can it get done right before tax day? So if your business is taxed as an S corporation, your ability to contribute to the plan is based off of the W-2 wages that you receive. So it's not necessary from a solo 401k perspective that you receive those W-2 wages on a weekly basis, like payroll or monthly. It could be paid to you as a lump sum, right? The key is that ultimately that amount is reported on a W-2, reported, by the business, et cetera, like any other W-2 wages. But it's not necessary that it's not really relevant, the interval in which the money is paid. What's relevant is that it's reported on the W-2 to justify that contribution. Hopefully that helps. Great question. So the focus of today's session is really for people whose business is taxed as an S-corp or C-corp or an LLC taxed as an S-corp or as a C-corp. We will be turning and having the same type of content and conversation for businesses taxed as a sole proprietorship. That's going to be starting the week of the 21st. So starting on the 22nd, you can see the schedule there posted on the community. So it'll be the same deep dive session for sole proprietors, 1099 contractors, single member LLCs. But in short, just to answer your question while you're here, the ability to contribute to the plan is always based on the self-employment compensation. So what that means depends on how your business is taxed. As we've seen from today's session, if your business is taxed as an S corporation, it's the W-2 wages that you receive from the S corporation. If your business is taxed as a sole proprietorship, you take your net income, which is line 31 of Schedule C, right after your business expenses, et cetera, reduced by 1/2 of the self-employment tax. And the result of that pre-calculation is your self-employment compensation. So then you can contribute, right, 100% dollar for dollar, for example, up to $19,500 as an employee contribution for 2021. So the calculator on the website will run that calculation for you. So to show you where that's at, let me pull that up. That's the one that we were looking at earlier in the slides. So if you go to mysolo401k.net, drop down under Learn, click on Online Tools, click there to use the Solo 401k calculator, click through. You'll choose unincorporated sole proprietorship. Then you enter your net income from line 31 of Schedule C, your age. You can run the report. You can view it in detail to really see the breakdown. Thank you so much for the good question. Please continue to participate and look out for the session for sole proprietors. So next question, if I file married jointly, and my wife contributed some amount to her employee deferral to her work plan, does that limit me to contributing to my solo 401k? No, it does not. So the ability for each person, great question, the ability for each person to contribute to the plan depends on that person's situation. So it depends on your age, the W-2 wages that you receive from the business taxed as an S corporation or as a C corporation, whether or not you made contributions to a day job plan. So your ability to contribute is not impacted by contributions that your spouse made to your spouse's 401k plan at his or her day job. Great question. So we do have a little bit more time if you want to post more questions. Otherwise, again, please like this video and please subscribe for more videos like this. This is the first in a series of many. So please, continue to engage and look out as we'll be continuing this conversation as it's that time of year when many people are making contributions. My spouse is employed but missed maximizing her employee deferral contributions with her work plan. So that's fine. I mean, as long as she's working in the business, receiving her own W-2 wages from the self-employed business, taxed as an S-corp or a C-corp, she can still contribute to the solo 401k. And if she didn't make any employee contributions to another plan, then she'll be able to make employee contributions to the solo 401k 100% dollar for dollar up to, for example, $19,500 for 2021, or an additional $6,500 for 2021 if she's 50 or older. Just follow-up question from the same person. Could she open a regular IRA brokerage? So yes, I mean, it's still possible, of course, to make IRA contributions. There's still time to set up a plan for 2021, and you could still at least make the employer contributions or even the voluntary after-tax contributions. It's just too late to make the employee contributions. Now, another thing to keep in mind is if you're trying to make contributions to both a solo 401k and an IRA, then your ability to make deductible IRA contributions you may not be able to make deductible IRA contributions if you earn too much. So let me send you a couple posts on both of those points. So here's a post on being able to still make contributions for 2021, even if the plan wasn't set up by the end of 2021. Here's a post that talks about contributing to both an IRA and a solo 401k. So take a look at that. That follows up in my comment about the ability to make deductible IRA contributions if you're participating in a 401k. Okay, thank you for the good questions. Next question, can you go over what the employer contribution limits are if I missed out on employee contributions for 2021 for solo 401k? Plan wasn't established in time for employee contributions. So first off, I would check out this post. Which talks about being able to contribute, or what you can contribute for 2021 if you set up the plan after the end of 2021. But in short, as long as you set up the plan here in 2022 before your business tax return deadline, including any timely filed extension, including opening the accounts and making the contributions, you can still make the full employer contribution, which is the 25% of the W-2. This is clear based on the Secure Act, et cetera, et cetera. But again, take a look at that post that I sent as it goes over in more detail. But so that means that, going back to the limits, right? Let's flip back to that. You can do the full 25% of the W-2 wages that you receive for 2021 as an employer contribution. Thank you for the participation. Next question. I set up my solo 401k plan in 2021. Can I make employee Roth contributions for 2021? Yes, as long as you set up, that goes back to our deadline discussion. Great question. So if you set up the plan in 2021, you would have preserved the right to make contributions for 2021 all the way up until your business tax return deadline, including any timely filed extension in 2022. So that's going to be March 15th of 2022 or September 15th. That's for all types, including Roth employee. So in terms of amending the W-2, yes, that would be the conservative approach. Here's the slide we talk about reporting contributions. So you can work with your tax advisor on that front. Thank you so much for the good questions. Okay, well, that seems like it takes us to the end of the questions. We really appreciate all the participation. Take care, everyone, and we look forward to the next time. Thank you so much.